Do you have money sitting in your bank account collecting dust? This is a mistake that a lot of people make when it comes to their paychecks. Most people leave their paychecks sitting in their checking accounts waiting to be spent. Aside from paying your bills, the money you earn should go towards making you more money. Many of us work hard for our money, but we don't really make our money work hard for us. In this video, we'll explore strategies that can help you turn your paycheck into more money instead of leaving it in your checking account. First, let's explore how you can legally reduce your tax liabilities. Tax deductions, credits, and exemptions are not just for the wealthy, they are available to everyone. Deductions allow you to lower your taxable income based on you contributing back to society or the economy. For example, if you earn $50,000 in a year and qualify for a $5,000 deduction, your taxable income would be $45,000. The deductions can be of two types, itemized or standard. You can choose between taking the standard deduction or itemizing deductions. The standard deduction is a fixed amount that varies based on filing status, while itemized deductions involve listing individual eligible expenses such as mortgage interest, medical expenses, and charitable or unreimbursed job-related expenses. On the other hand, tax credits reduce your tax bill directly. They act as a dollar-for-dollar reduction in the actual amount of tax you owe. For example, if you owe $2,000 in taxes and qualify for a $500 tax credit, your final tax liability will be $1,500. Some examples of tax credits include child tax credit, earned income tax credit, American Opportunity Credit for education expenses, and renewable energy credits. They are provided by tax authorities, whether at the federal, state, or local level, to encourage specific behaviors or support certain groups. Importantly, there's a world of tax-advantaged accounts out there, like individual retirement accounts or IRAs. These accounts are specifically designed to help you save for retirement while offering you tax benefits. A traditional IRA, for example, allows your contributions to grow tax-deferred until you withdraw them in retirement. This means you won't pay taxes on your contributions until you're ready to retire, which could potentially save you a substantial sum. By leveraging these opportunities, you can increase the amount of money you keep from your paycheck. Make sure you consult a tax professional before making any plans or purchases. The tax laws and the eligibility criteria are complex and easy to misunderstand. They can provide guidance on maximizing available credits while ensuring compliance with tax regulations. The second strategy is utilizing a high-yield savings account. High-interest savings accounts are like your regular savings account, but with a twist. They offer a higher interest rate, allowing your money to grow faster. The beauty of these accounts is that they work in the background, silently adding to your wealth while you focus on other aspects of your life. Your money is not just sitting there, it's actively working for you, generating more money over time. One thing to keep in mind is that the money it generates can change over time based on the market. The interest rates vary from bank to bank, so make sure to shop around to get the best deal. High-interest savings accounts are popular choices for building emergency funds and saving for short-term financial goals due to their safety, accessibility, and the potential for faster growth compared to standard savings accounts. Start exploring high-interest savings accounts today and let your money work harder for you. The third strategy is to invest in education and training. Investing in education and training is a powerful way to maximize the value of your paycheck. By enhancing your skills and qualifications, you become a more attractive candidate in the job market, potentially leading to better job opportunities and higher pay. Consider enrolling in courses, workshops, or certifications related to your field. These can provide you with the latest knowledge and techniques, setting you apart from others. It's not just about formal education, though. Investing in books or other resources that expand your knowledge is equally important. Staying up to date and informed about trends in your industry can give you a significant advantage. Remember, knowledge is power. The more you know, the more you grow. By investing time and money into your personal and professional growth, you're making a long-term investment in your financial future. Now let's talk about the fourth strategy, which is growth investing. It's something that might seem intimidating or complex, but it's simply about growing your money over time. Think of it as planting a seed and nurturing it to become a tall tree. The seed, in this case, is your money, and the tree is the wealth that you grow over time. There are different ways to invest your money. Stocks, for instance, give you a portion of ownership in a company. When the company does well, your stocks appreciate in value. Bonds, on the other hand, are like IOUs where you lend your money to a government or corporation for a certain period of time in return for interest payments. And then there's real estate, where you invest in property and generate income from rent or appreciate in value over time. Investing is a powerful way to grow your wealth over time. Investing for growth is typically considered a long-term strategy that harbors a higher level of risk compared to other investment strategies. To reduce risk, you should diversify your portfolio across different asset classes and industries. Make sure to regularly monitor your investments and adjust your holdings based on changing market conditions, financial goals, and risk tolerance. It's important for individuals adopting a growth-oriented strategy to be aware of the associated risks and fluctuations in the market. While growth investments have the potential for higher returns, they also come with increased volatility, and past performance is not indicative of future results. Consulting with a financial advisor can help individuals tailor their investment approach to align with their specific financial objectives and risk tolerance. The fifth strategy is dividend investing. Investing isn't just about growth. It can also provide a steady stream of income with dividends. Dividends are essentially a portion of a company's profits that are distributed to shareholders. When you invest in dividend-paying stocks, you're buying a share of a company's future earnings. Every quarter, or sometimes annually, you receive a dividend payment, a slice of the company's profits, straight into your account. Now, why should you consider dividend investing? 2 reasons. 1, it provides a regular income. Even if the stock price doesn't increase significantly, you're still earning from your investment. 2, it's relatively more stable. Companies that have a history of paying dividends are often well established and financially stable. Remember, dividend investing isn't about getting rich quickly. It's about building a steady, reliable income over time. And that's a pretty smart way to make your paycheck work harder for you. The 6th and 7th strategy is peer-to-peer lending and certificates of deposits. As we move beyond traditional savings and investments, we come across 2 unique methods to make your money work harder: peer-to-peer lending and certificates of deposit. Peer-to-peer lending is a modern take on an age-old practice. Think of it as being the bank, lending your money to individuals or small businesses in need. These platforms connect borrowers with lenders, that's you, and you earn interest on the money you lend. It's as simple as that. The key here is to diversify your lending to minimize risk. Don't put all your eggs in one basket, but rather, spread your money across multiple loans. That way, even if a borrower defaults, your overall return is not significantly affected. Now, let's shift gears and talk about certificates of deposit, or CDs. These are time-bound deposits you make with a bank, which offer a fixed return after a certain period. In exchange for this commitment, banks offer higher interest rates than regular savings accounts. So if you have some cash that you won't need for a while, CDs are a great option. But remember, every investment comes with its own set of risks. With P2P lending, the risk lies in the possibility of the borrower defaulting on the loan. And with CDs, there's the risk of interest rates rising in the market while your money is locked in at a lower rate. So always do your homework and consider your financial situation and goals before making a decision. By exploring these alternatives, you can diversify your income sources and further optimize your paycheck. It's all about making your money work for you in as many ways as possible. So take the leap, explore your options, and watch your wealth grow.